Hi there traders, and welcome to the first video of June. Hope it finds you in good spirits. Really pleased to have got such positive feedback from the previous video that I did a couple of weeks ago in regards to trading strong currency pairs against weak currency pairs. I try and have something in the video that you can take away and use straight away. So the fact that I've heard about some really nice pit returns from some of the trades that we looked at in that last video is really pleasing for me, and gives me further motivation to keep doing these videos. So that's really good. Now, part of the feedback that I also got from you guys was the fact that trading strong versus weak is a great strategy. However, because they're strong and weak currency pairs that you're trading, this is normally a reason why they're strong or weak, and when you look underneath the technicals, it's normally being driven by a fundamental reason or news reasons why it's creating a currency to be strong or weak. Now, alongside that comes great volatility, and volatility is an important thing for us as traders because we need it to push us into profit, but also it can be a negative thing because volatility can also go against us as a trader. Now, volatility going against us and pushing our position into a negative position causes stress. Even if you're a seasoned trader, you are going to suffer stress when you're seeing a negative position on your trade, because we've got a connection to money, it's a sensitive thing, and we're going to have stress, and that stress can relate to emotion, and emotion can cause us to do all the things we know we shouldn't do as a trader. So some of the feedback I got was that it was pretty volatile trading those setups and those opportunities. Now, last week was quite unusual because it had such an abundance of high impact news. It's not usually like that. However, we are always going to get high impact news coming out, but last week was quite unusual in terms of everything seemed to come together in 1 week. So that is quite unusual, but essentially we are going to have to sit through volatility, both good volatility as the markets take our position into profit, and also negative volatility as the market takes our position, some of our positions into a negative. But sitting through that and having faith and conviction and confidence in your position is absolutely everything. But I know that's not for everyone, that style of trading, and I understand that and appreciate it. So one thing I want to concentrate on today is looking at a potentially lower volatility approach to trading the markets and a higher probability of success. Now, it means waiting very patiently, but essentially as a trader, all we want to do is at the end of a 12-month period have made money, have made growth on our capital. So if it takes us if we're trading every day to achieve that, then great. If we're trading just 2 or 3 months out of the 12-month period and we still make money, then great as well. So it all comes down to individual circumstances and what you're looking to get from your trading. But this is a technique that it's not very technical. It's based purely on fundamentals, and it's a very rare occurrence that it happens. But when it does happen, really you can focus heavily on that opportunity or that currency pair and really take advantage of it and take a nice return. Sometimes just by concentrating on 1 or 2 currency pairs during a 12-month period, you can still result in a decent double-digit return on your investment. And what that is really trading alongside the central banks. The central banks are huge, and when they want to do something to their currency, strengthen or weaken it, they are prepared to throw billions of pounds worth or dollars worth or whatever it may be, local currency, to ensure that they get a certain outcome on their trades. Now, the most obvious examples of late have been quantitative easing that we've seen in the US and also in Japan to weaken their currency pairs so that they could stimulate economic growth. Now, if we can firstly find out about that, which will always come through the free news feeds, your Forex Factory, your Bloomberg, etc. That will be announced to the market. And when you see things like quantitative easing, you'll find that the market is very one-directional, and you have the confidence to trade in that direction because you have the confidence that you are trading alongside a central bank, which is the major player in the market. No hedge fund, no independent trader is going to be able to match a central bank in terms of liquidity. So we want to be looking at some certain scenarios where we can take advantage of that. And there's a few things setting up potentially over the next few months. Now, I'm not saying it's going to happen overnight, but the next few months where we could potentially see some of these scenarios playing out. And this is where we want to then look to take advantage of these opportunities, because they'll come and go periodically for a few months, and then they'll be gone and we won't be able to take advantage of them anymore. So it's all about arming ourselves, focusing in on what could potentially set up over the next few months, and then take advantage of those scenarios as and when they set up. So we're just going to have a look at 3 scenarios that could potentially set up in the next few months, just to give you some advance notice, some advance warning, so you can prepare yourself for these potential announcements as and when they come. Now, first is the euro. The euro is interesting. I know I banged on about in the last video, I banged on about how the euro was likely to weaken off the back of the ECB statement, because they'd threatened that they were going to do that they were going to be very, very aggressive in their tactics to weaken the euro, because the high euro exchange rate is causing the economy to struggle. However, when they came out and all they did was reduce the interest rate, the base rate, by 0.10, the market was like, is that all you're doing? So all their aggressive threats were not followed through. The market was expecting some quantitative easing, some aggressive tactics that would confirm that the ECB is now stopped talking and is ready to act. The fact that all they did was reduce the base rate was pretty pathetic, and the market, as we saw, headed lower during the announcement, but then when the market realized what they'd confirmed, it started buying the market back up again. The euro dollar started to push back up, and we saw on Thursday that the big bullish outside bar. So it looks likely that the market has shrugged off that initial threat, verbal threat, and is looking likely to send the market higher. However, the ECB are getting pushed further, and ECB is the central bank for the Eurozone. The ECB is getting pushed further and further into a corner where they are going to have to act. So even though they didn't do what they promised this time, the more that the market pushes it back up to the 1.4000 level, the more that they're going to be pushed into acting. So the level that it reacted to before, a couple of times, the big 1.4000, the ECB has already confirmed that if the market or the exchange rate is at that level, that they would feel extremely uncomfortable, because that is going to damage the economic growth across the Eurozone. So it's an area for us to watch carefully. Now, we want to see the market push it back up to that zone, and then we want the ECB to confirm what they're going to do. And if QE comes in and they start to weaken their currency pair, that's when we want to be looking to sell the euro, because you know you will be trading with the ECB, and they're prepared. If they're going to act, they are prepared to throw a lot of money, a lot of weight behind weakening the euro, and you're going to be trading alongside that. So you're going to have so much more confidence and so much more conviction and a higher probability of success. So that's the euro looking at the 1.4000 level, and it looks like the market over the next few months, weeks and months, is going to push it back up there to test the ECB. They want to test the ECB to see if they can follow through with their verbal threats with physical action. The reduction in the interest rate was pathetic in the eyes of the market. And last time the market, I can't remember where it was, I think it was around about November time. That was when the last rate cut was. Market pushed it down off the initial sentiment and then started to buy it back up into that 1.400. So it looks like the same scenario is going to happen now. So be keeping your eyes on this. It's going to take a little bit of time to get up there, but as it goes higher, the ECB is going to be pushed further into that corner where they're going to have to act. And if they do act again, we wait for the confirmation that they act. That's when we want to be looking for the euro shorts. So that's the euro. Very, very interesting indeed. Another one that's very interesting is the euro Swiss. Now, the SNB, which is the Swiss central bank, put a peg at the 1.2000 level. So just down here, they said to the market, if the exchange rate gets down to the 1.2000 level, they will do all it takes to protect that level. So they have confirmed that they will again put all their weight of a central bank behind protecting that level. Now, it's got a way to go, but if we get a similar drop from the start of the year to down here was roughly 290 points. It's stagnated and gone sideways. If it breaks lower into this area, that's around about 230. So if it has another leg down like it did previously at the start of the year, then we could get a nice push down into this zone, into the low 21s to around about the 20s. We'll be looking, certainly me personally, will be looking to buy in this zone here, because I'm confident that I can drop my stop loss. It may be quite wide, but I can drop it just underneath that 1.20 level. Confident in the fact that I know the Swiss central bank will protect that level, and they will do all it takes to protect that level. And I think they were talking about the 2.5 level being a more comfortable level for this particular currency pair, so that gives a nice room for a healthy profit. So even though our stop loss may be quite wide, to tuck it underneath that 1.20 level, it's got room for nice potential to the upside. Again, the reasons for taking the trade aren't technical, even though we will use a technical strategy to look to get into the trade. It's trading with the central bank, confident, high conviction, and more likely to take that trade. Now, it means sitting on our hands and waiting for that to happen, but once it happens, we can look to take it with a lot more conviction and ride it up to a nice profit. So that's the Euro Swiss looking at the 1.20 level. As it drops down below the 21 level, 1.21, I will be starting to look for technical entries to get into that market, because it's coming very, very close indeed to the 1.20, where we know the SNB will intervene. And then the other one was the dollar yen. You're probably all aware of the QE on the dollar yen, which started back in, where do we see it when they first started to intervene, was around about November 2012. Now, as you can see from the chart, technically, I know it's looking back in time and it's all hindsight, but essentially they came out and said, we are doing an asset purchase program, QE. We're going to be very aggressive in weakening the Japanese yen, because it has been dollar yen has been falling, which has meant that the Japanese yen was massively strong, and that was hurting their exporters, which in turn was hurting their economic growth. So they said, we're going to do all it takes to make sure that we weaken the JPY, and it makes our exporters more attractive and we can stimulate economic growth. So in this period here, during 2012 into 2013, you could have just concentrated on buying dollar yen, nothing else, and that would have given you a very healthy return on your investment. Even if you were only trading it for 3, 4, 5 months, that would have given you a healthy profit, a healthy return on investment, just by concentrating on the one currency pair where the government had confirmed that they would do all it takes to weaken their currency pair, so looking to buy dollar yen. Now, we saw that after a period of time it started to fade before they then started to aggressively weaken their pair again, and the market has since come all the way back down and has started to stagnate. So if they come out with another confirmation that they're going to add to their QE, now data out of Japan has been pretty good of late, so they've been saying that actually everything they're doing is working, economic growth is being stimulated, so they may not add to their stimulus. If that's the case, then we don't trade in this style on the dollar yen. We look for more, we use our other strategies to take advantage of that. But if they come out, if the data comes out negative over the next few months and they say actually we're going to have to add to our stimulus, we're going to have to continue weakening the JPY, the Japanese yen, that's again another big factor in you looking to take some long trades on dollar yen. So you're looking to take advantage of dollar yen as much as possible. Now, people always go, well, how do you know when it's going to end? But hey, let the market tell you when it's going to end. You're going to have enough opportunities on the way up to then accommodate maybe a losing trade or two when the market says, okay, enough's enough. But you know that you're going to get confidence and conviction, which is everything in trading, because you're less likely to change and interfere with your trades from the fact that you are trading with the strongest player in the market, which is a central bank, and they're prepared to do all it takes to make sure that they get the outcome of their actions. So that was dollar yen, and you've seen other examples on the dollar Swiss. The SNB had to intervene when the Swiss franc. Let's have a quick look at that. I think it was back in 2011. The market had been bringing the dollar Swiss down heavily, and that meant that the Swiss franc, so the market had bought it down heavily, dollar weak, Swiss franc strong. The Swiss government said, it's hurting our economic growth because our exporters are too expensive. We have to do something about it. QE program announced, bang, off it goes. All of a sudden they're weakening their currency. And dollar starts to strengthen, Swiss franc starts to weaken. Again, this opportunity here, looking for long opportunities, dollar Swiss. Again, that could have been your one currency pair for 2011, which generated you a healthy double-digit return quite comfortably during that period. And you're only trading for maybe half of the year. But you know that you're trading with the central bank, and that is a powerful, powerful concept. So if you're uncomfortable and not yet got on top of the emotional side of trading, you may want to just think about this. Now, it does mean you not trading that frequently, but at the end of the day, are we there to trade frequently? Or are we there to make money? I don't care how many trades I take, so long as I'm profitable at the end of 12 months. Now, each of us are going to have different styles and different techniques, but one thing you can take away is if you do get a news announcement, and you can find this on all your free news feeds, Forex Factory, etc. If you do get confirmation that the central bank is prepared to do something to intervene with a currency to have a certain outcome, weaken or strengthen, whatever it may be, then you want to be part of that because you are trading with the central bank. And if we can trade with the central bank, our probability of success is increased exponentially. So I'll leave that with you. I hope that's helped for those of you that just want to trade a little bit infrequently throughout the year. Is just sit on your hands, wait patiently until you get confirmation of a central bank intervening to create a certain outcome, and then look to trade more aggressively through that period until the market starts to give you signals, or there's confirmation in the news feeds that the central bank has stopped doing what they were doing, and then you stop. As we've seen with all of these examples, there is plenty of opportunities to get a nice return on your investment. So hope that's helped. Last week was for the more aggressive traders, this week for the more conservative traders. And again, you can combine the two or concentrate on one or the other, and then add your technicals on top of this scenario. So I'll leave that with you. Have a wonderful trading week, and I will catch up with you in due course. All the best.